The standard deduction versus itemized deductions claimed on IRS Form 1040 individual income tax return. As one might well anticipate, individual taxpayers seeking to better understand claiming the standard deduction versus itemized deductions want to understand what other taxpayers across the United States are doing and understand where there might be value in proceeding with one approach to offsetting their personal taxes as against another approach, even though their individual circumstances are absolutely critical, such that we look at statistical information provided by the Internal Revenue Service to better understand the choice in taxpayer deductions. And this is a pretty significant realm, given that the total amount of such deductions, being the sum of standard deductions composed of basic standard deduction, the additional standard deduction for blind or the elderly, and the disaster loss standard deduction, and total itemized deductions had risen to $3.1 trillion for the 2020 tax year. Now, from a purely empirical perspective, 87.3% of individual income tax returns filed in 2021 for the 2020 tax year claimed a standard deduction, with the standard deduction accounting for 80.4% of the total monetary amount of these deductions. The average standard deduction that individual taxpayers were able to claim increased from $17,021 for tax year 2019 to $17,383 for tax year 2020. In sharp contrast, individual taxpayers only claimed itemized deductions on 9.5% of filed income tax returns. Although this segment of taxpayers, representing less than 1/10 of the individual tax filers, accounted for 19.6% of the total monetary amount of these deductions. As such, the average total of itemized deductions was $39,105 for 2020, up from the $37,184 average total claimed for 2019. Meaning that taxpayers were claiming on average 2.25 times in itemized deductions as were taxpayers claiming the standard deduction. However, as the IRS's own statistical analysis identified, the number of income tax returns with itemized deductions decreased 10.5% from 2019 to 2020 to 15.5 million income tax returns. The order of top itemized deductions for 2020 was 1. Charitable contributions, 2. Interest paid, in particular mortgage interest, 3. Taxes paid, primarily salt and sales taxes, 4. Qualified business income deduction, 5. Medical and dental expenses, and 6. Gambling losses and other unlimited miscellaneous deductions. Charitable contributions increased 7.7% from 2019 to $204.7 billion, despite the number of returns with these contributions declining by 12.6%. This was partially due to the removal of adjusted gross income limitations for most cash contributions made in 2020. Interest paid decreased 13.9% from the previous year to $178.6 billion, with mortgage interest accounting for 88.4% or $157.8 billion of the total interest paid deduction. Prior to 2018, the total taxes paid, which included state and local income and sales taxes, were the largest itemized deduction. However, tax law changes limited the deductions after 2018 to a combined total deduction for state and local income and sales and property taxes of $10,000 and $5,000 for married filing separately. Thus, for 2020, after the limit, total taxes paid decreased another 10.6% to $124.2 billion. This was followed by the qualified business income deduction, which was reported by 22.8 million taxpayers for 2020 and represented deductions amounting to $166 billion, Next, deductions for medical and dental expenses after the adjusted gross income limitation, reported by 3.9 million taxpayers and representing $77 billion in deductions. And finally, gambling losses and other unlimited miscellaneous deductions, reported by 702,000 taxpayers and representing $21 billion in deductions. Hopefully, this provides some added perspective with respect to the standard deduction as opposed to the itemized deductions for purposes of individual income tax return preparation and filing, for which the IRS's own statistical data can provide some very insightful information for the discerning taxpayer. Thank you.